MasterCard, ticker symbol MA, is one of the best dividend growth stocks you can buy. The company has an extremely low payout ratio, around 20%. The dividend is growing at a 19.62% 10-year compound annual growth rate. This has slowed down slightly to a 3-year CAGR of 14.47%. The company just reported earnings and is up 3.63% on the news. This is quite different from the decline that Visa stock saw during its earnings report. So today I'm going to do an updated analysis on MasterCard's stock, break down their Q2 earnings report, and share whether I'll be adding MasterCard to my long-term dividend growth stock portfolio. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. And if you want to be notified about these videos and a ton of other bonus content, then sign up for our email newsletter. Link in the description and pinned comment. So as many of you who follow the channel know, I just made Visa the number 2 position in my long-term dividend growth stock portfolio. Their business model is fantastic, highly scalable, high margin, and has a large tailwind behind it as more and more of the world switches to digital payments. MasterCard stock shares much of these qualities. The core business model is practically the same at both companies. Both Visa and MasterCard operate a digital payment network that authorizes and clears transactions. On top of that, they provide value-added services to various financial institutions. And a core thing to understand about these two companies is that they do not issue cards themselves. Therefore, they do not bear any direct risk in regards to credit. Instead, they partner with financial institutions and fintech companies to issue cards on their behalf. Visa and MasterCard operate the payment networks, and that has become a fantastic business model. Since going public, MasterCard's earnings have continued to grow at a high rate. The stock price has followed, although it was in a 3-year lull between 2020 and 2023. This is despite earnings growing significantly in that time. MasterCard's revenue per share is growing at a 14.45% 10-year compound annual growth rate. Over the past 3 years, this is a 20% CAGR. The company has a very high margin business with 76% gross margins, 57% operating margins, and 44% net margins. Net income per share is growing at a 16.51% 10-year compound annual growth rate. Free cash flow per share is growing at a 14.53% 10-year CAGR. This is accelerated over 5 and 3 years. MasterCard and Visa are free cash flow machines. So what do they do with it? They pay a fast-growing quarterly dividend. The 5-year compound annual growth rate of the dividend is 14.87%. The most recent dividend increase was 15.79%, and this dividend payment is extremely sustainable at an 18% free cash flow payout ratio and 19% EPS payout ratio. However, MasterCard always has a low starting dividend yield due to its high multiple it trades at. However, that multiple is deserved due to its high growth rates and future potential for continued growth. On top of dividends, they buy back shares at around 2.5% a year. MasterCard has far more international exposure compared to Visa. MasterCard has 33% of their business in North America and 66% internationally. If we compare to Visa, 43% is in the United States and 56% is non-US. So let's break down MasterCard's latest earnings report, and then I'll come back to compare it a little bit to Visa stock and provide a price target and earnings estimates for MasterCard. And by the way, if you want to use the tool I'm showing throughout the video, this is all available at dividenddata.com. I created this tool to help me make better investing decisions, and it more than pays for itself. So for MasterCard's second quarter, revenue grew 11% year over year, operating income grew 10% year over year, and using GAAP accounting, net income's up 15% year over year, and earnings per share is up 17% year over year. However, if we use non-GAAP accounting, then adjusted net income is up 22% year over year, and adjusted EPS is up 24% year over year. Gross dollar volume on their payment network is up 9% year over year. Cross-border volume is up 17% year over year, and switch transactions is up 11% year over year. And during the most recent quarter, MasterCard repurchased 5.8 million shares at a cost of $2.6 billion and paid over $615 million in dividends. And if we look at the second quarter gross dollar volume on their payment network, that grew 9% year over year worldwide. And if we break this up by regions, it was 6% growth year over year in the United States and 11% growth year over year internationally. On top of this, the number of MasterCard MasterCard cards issued grew 7% year over year. And when Visa just had their earnings report last week, I made a video and wrote a newsletter breaking it down, and we can use their recent performance as reference. So Visa's net revenue was up 10% year over year. GAAP net income was up 17% year over year. GAAP earnings per share was up 20% year over year. However, non-GAAP net income was only 9% year over year, and non-GAAP EPS was only 12% year over year. So MasterCard had it beat significantly in terms of non-GAAP, and revenue was basically the same at 10 or 11%. Visa had a 7% growth in payment volume year over year, with cross-border volume up 14% year over year and processed transactions up 10% year over year. However, one of the concerns in Visa's earnings report was that growth was slowing in recent months. So there was a slight deceleration. And this trend is actually not being seen as much in MasterCard's stock. Specifically, it seems like the growth rates are much higher worldwide compared to in the US. It's worth noting, though, that we're talking about a 1 to 2 point difference, though, between Visa and MasterCard. However, historically, MasterCard has grown faster, and analysts are projecting it to grow faster into the future. This is why MasterCard trades at a 36.8 P ratio compared to Visa's 27 P ratio. Analysts are projecting 13% growth in 2024, 15% growth in 2025, 16% growth in 2026, and 17% growth in 2027. So these are pretty high estimates, but I do think they're reasonable. And based on that, MasterCard would have a 20 P ratio in 2027. However, in that year, if they're trading at a 35 P ratio at that price, considering there will be future growth years forecasted then, the stock price would actually be closer to $780. And using that as a basis, MasterCard stock will have pretty great returns from here, about 70% over 4 years. However, MasterCard stock is currently trading above the consensus price target among Wall Street analysts. It is a small margin though, around 2.6%. The consensus price target is $451.48. The lowest target is $298, and the high on Wall Street is $545. And if we compare that to Visa stock, it is trading 7% below the analyst's consensus price target. Despite that, though, MasterCard still has an overwhelming buy rating, with even some people saying strong buy. Other concerns with MasterCard I have compared to Visa is that they only have $7 billion in cash on hand, compared to $19.5 billion with Visa. Additionally, Visa has basically only $1 billion of net debt, while MasterCard has $8.61 billion net debt. So their balance sheet is objectively weaker compared to Visa, and the stock does trade at a much higher multiple. However, they do grow earnings slightly faster and have higher return on capital employed at around 55%. This is compared to Visa's 30%. Those are both strong numbers though. So in conclusion, I don't think you can go wrong with either MasterCard or Visa in a long-term dividend growth stock portfolio. These things will do great from a total return standpoint. Both companies have such dominant market positions, and their business model is practically flawless. They are so dominant they're considered a duopoly, and the main problem is actually from government regulation, not the business realities. So will I add MasterCard stock to my portfolio? I'm actually heavily considering it. Originally, I just picked one since the businesses are so similar, but I'm starting to think it may not be a bad approach to just own both. So subscribe and stay tuned to see if I add MasterCard stock to my portfolio anytime soon. Thanks for watching, and sign up for dividenddata.com to use the stock research tool I've been showing throughout. See you next time.